Have you ever wondered why different currencies have different values, how they are compared, and ultimately, what or who determines the price of a currency? Why is the British pound worth more than the US dollar, even though the US economy is significantly larger than the British one? And why is the US dollar cheaper than the euro, even though, unlike the euro, it serves as the world's primary reserve currency? If we answer briefly, money is just another commodity, like bread or oil. Its value is determined in the same way as the value of other goods, on a vast global market, governed by the simplest law of economics, supply and demand. But that explanation is too simplistic. If you truly want to understand how these mechanisms work, not just at the surface level, then this is worth exploring in depth. Chapter 1. Preservation and Growth. From economic theory, we know that money represents stored value. Imagine you are a farmer producing bread. The bread you produce contains your labor, your knowledge, and the time you invested in making it. That is why it has value. But you also need other things besides bread. For example, fuel. As economies expanded, direct barter became impractical. Money emerged as a solution, making exchange more efficient. However, as we also know from economics, everything comes at a cost, including convenience. There are times when people lose their entire wealth, not because of their own actions, but because their national currency loses value due to financial crises, wars, or irresponsible government policies. In essence, real human effort, labor, knowledge, and time gets converted into money, and then that money can simply vanish in value. This has happened in Weimar Germany, the Soviet Union, and Zimbabwe. Doesn't that seem like a kind of magic? Or perhaps a mix of magic and, at times, manipulation. When it comes to material wealth, people always face two fundamental challenges: how to increase it and how to preserve it. In the modern world, wealth is primarily stored in the form of money, so naturally people try to protect it. That seems logical, doesn't it? Imagine you have the option to exchange different types of food. You trade potatoes for tomatoes and tomatoes for apples, because you've heard that potatoes and tomatoes are being heavily affected by parasites this year, while apples store well. In a similar way, the global currency market works like a marketplace where currencies are exchanged just like goods, because currencies are in essence a type of commodity. That is why individuals and companies hold their wealth in currencies they trust, currencies they believe will not suddenly lose their value. This means they sell their local currency and buy, for example, US dollars. As demand for the dollar increases, its value rises, while the value of the local currency falls. Large institutional investors operate on the same principle. Seeking not only to preserve but also to grow their wealth, they pay attention to countries with higher interest rates. For example, if interest rates in the United States are 5% and in the Eurozone they are 8%, capital tends to flow into Europe. Investors convert dollars into euros and invest in euro-denominated assets to earn higher returns. As a result, demand for the euro increases and its value rises relative to the dollar. Chapter 2. Inflation. If a country's central bank decides that there can never be too much money and simply starts printing more, the situation becomes dangerous. The amount of money in an economy should correspond to the amount of goods and services available. This is a fundamental principle. If the money supply increases significantly, while the number of real goods, such as food, housing, or services, remains the same, money begins to lose its value. When there is too much money, it effectively turns into paper, with diminishing purchasing power. A historical example of this occurred when Spain brought large quantities of silver from the New World into Europe over a relatively short period. This caused prices to increase several times over, while incomes did not keep up, leading to widespread hardship. A more extreme example is Zimbabwe. In an attempt to cover government spending, authorities printed excessive amounts of money, which led to a collapse in confidence and hyperinflation. At a certain point, the currency became practically worthless, and the country eventually abandoned it in favor of more stable foreign currencies, including the US dollar. When a currency experiences higher inflation than others, it loses value faster. As confidence declines, people try to get rid of it, which further accelerates the process, creating a domino effect. In such situations, governments, especially less democratic ones, often impose restrictions on buying foreign currency or moving money abroad, and may attempt to fix the exchange rate to another currency, such as the dollar. Chapter 3: Exports and Imports. This is commonly referred to as the trade balance. Germany is one of the largest exporters in the world. When companies like Mercedes or BMW sell cars in the United States, they receive dollars, which they then convert into euros, since the euro is the official currency in Germany. This increases demand for the euro, strengthening it relative to the dollar. In some cases, exporters require payment directly in euros. This means foreign buyers must purchase euros beforehand, further increasing demand. Now consider a country that imports significantly more than it exports. If a country like Ukraine buys more goods from abroad than it sells, it must exchange its local currency for foreign currencies, such as dollars or euros, to pay for imports. As a result, its national currency is sold more frequently, which puts downward pressure on its value. To stabilize the situation, governments may use foreign currency reserves to support their own currency by selling foreign currency in exchange for the local one. Some export-oriented economies, such as China or Russia, deliberately keep their currencies relatively weak. This gives their exporters a competitive advantage. If the currency depreciates, domestic goods become cheaper for foreign buyers. However, there is a downside. Imports become more expensive, as do travel and foreign goods, which can offset some of the benefits. A country's economy can be compared to a company, and its currency to a stock. If a company performs well and generates profits, its stock price rises. A similar dynamic applies to currencies. Economically strong and growing countries attract foreign investment. Investors seek opportunities where markets are expanding and returns are higher. When capital flows into a country, investors must purchase its local currency, increasing demand and strengthening it. Interest rates and overall monetary policy also play a significant role, as discussed earlier. Another key factor is government debt. If debt grows faster than the economy, it can discourage both domestic and foreign investors, as it raises concerns about future inflation or financial instability. At this point, economics gradually overlaps with politics. Money tends to prefer stability. Some of the strongest currencies belong to countries known for their political and institutional stability, such as Switzerland or the United Kingdom. If a country has unstable politics, weak legal systems, or unpredictable leadership, investors become cautious. They may fear changes in rules, loss of assets, or economic mismanagement. At the same time, local residents may move their savings into foreign currencies or transfer them abroad to protect their wealth. This creates a feedback loop, putting further downward pressure on the national currency. Chapter 5: The Strength of a Currency. Let's take the exchange rate between the US dollar and the euro as an example. What determines their relative value? And why is the euro often more expensive? The United States has several advantages that support the dollar. First, there is strong global trust in the dollar as a reliable currency. Second, U.S. Treasury securities are considered among the safest financial assets in the world, and purchasing them requires dollars. Third, the United States is one of the leading destinations for global investment. To invest in American markets, investors need dollars. At the same time, factors in Europe also support the euro. These include relatively stable monetary policy, lower inflation in certain periods, and strong export performance, particularly driven by countries like Germany. Additionally, when the euro was introduced, it was initially set at a higher level relative to the dollar. For it to fall significantly below the dollar would require major economic disruptions in the eurozone. All of these factors combine to form the exchange rate, much like the relative prices of goods in any market. The foreign exchange market, or Forex, is a massive global system where banks, corporations, and investors trade currencies in volumes reaching trillions of dollars daily. Exchange rates change constantly, reflecting shifts in supply and demand. But does a stronger currency always mean a stronger economy? No. The British pound has traditionally been more expensive than the US dollar, despite the UK economy being much smaller. The Japanese yen is far cheaper than the pound, even though Japan's economy is larger than the UK's. The Kuwaiti dinar is more than 3 times stronger than the dollar, but that does not mean Kuwait has a larger or more influential economy. A higher nominal exchange rate does not indicate greater economic power. Why? Because the nominal exchange rate, the number you see on the screen, depends on many factors: interest rates, investor confidence, historical conditions, and even the total money supply in circulation. It shows how currencies compare to each other, but not the true scale or strength of an economy. In some cases, currencies of smaller or less influential economies can have higher nominal values. The British pound, or the Bahraini dinar, for example, are worth more than the dollar, while the Ukrainian hryvnia is stronger than the Russian ruble in nominal terms. The reasons vary: historical factors, monetary policy, or differences in money supply. Some countries maintain strict anti-inflation policies, which can support higher exchange rates. Others, especially export-driven economies, may intentionally keep their currencies weaker to support competitiveness. Some resource-based economies, such as Saudi Arabia or the United Arab Emirates, peg their currencies to the US dollar. This means maintaining a fixed exchange rate by using foreign currency reserves. This approach can provide stability, but requires substantial reserves. Without them, countries may face serious problems, as seen in cases like Argentina. Conclusion: a strong currency does not necessarily mean a strong economy, and a weak currency does not necessarily mean a weak one. If exchange rates differ by large margins, the reasons are often historical. But when exchange rates change in real time, they reflect something much more important: how much the world trusts a country's economy right now, and how willing people are to hold its money